What happens to your money in a bank? Fractional reserve banking. So, you work hard at your job, get a salary, and then what do you do with it? Obviously, you will spend some and put the rest in the bank. Then what? You might think nothing happens as it shows the same amount in your account and you can use it. But a lot of amazing things happen to your money that you might not be aware of. To understand this, we have to understand the concept of fractional reserve banking. Fractional reserve banking is keeping a fraction of money deposited as reserve and lending out the remaining to other people or businesses, etc. Simply told, the bank holds a fraction of your money and loans the rest. The central bank of each country prints currency or money. The central bank is controlled completely or partly by the government in most countries. Also, the percent of fractional reserve is decided by the government and central banks. That we had taken as 10% in the example. Note that by controlling the rate of reserve, the central banks can control the supply of money and rate of loans in the country. So, the central bank print that physical money or make electronic money, and then they can give this money to people doing government jobs, people selling stuff to government. Also, central banks gives loans to the private banks. This way the new money is created and brought into circulation. What if people who had deposited their money want it all back? This is a very important question to ask. When a large number of people simultaneously try to withdraw all their money, it might be because they have lost faith in the bank and think that the bank will default, fail. This is called a bank run, and you understand the reason behind the name. If people withdraw a lot of money, the bank might not have enough cash in its reserves, as we know it only keeps a fraction of the money. To pay the people, the bank sells its assets quickly and may become insolvent, bankrupt. Bank runs have happened a lot of times in the past. In the Great Depression, the 1930s, multiple bank runs occurred simultaneously, leading to worldwide banking crises. After the Great Depression, government introduced a fractional reserve system and not to loan out all of the money, and some money is protected as before all the money of depositors was loaned out. When a bank defaults and is unable to pay the people their money, the central bank has rules that safeguard a certain amount of money for each account. That is, whatever happens to the bank, this amount is ensured by central bank per bank account in the country. This is because the central bank can make more money, currency. Note that they are not creating wealth but currency, money. For example, gold, iron, etc. can be wealth as they have some value, but the currency is just paper, it is just a medium of exchange, it has no intrinsic value. Understanding fractional reserve banking at a worldwide scale. Similarly, in the world, there are a lot of banks, a lot of people depositing their money, and a lot of people taking loans from the bank. The volume of exchanges, deposits, and borrowing is too high in the world to imagine. Pros and cons of fractional reserve banking. Fractional reserve banking might seem like a very complex pyramid scheme, as banks take your money and give it someone else and so on. And there are a lot of critics of this system. Because banks have controls of your money, so what if they put your money in a very risky loan or investment? The banks have control of your money, but they must behave responsibly. But why should they? As if a risky investment fails, the bank is rescued by the central bank. We can also argue that you as an individual do not know about investing or finance, so banks can use their expertise and technology to put that money to good use and raising the worldwide economic benefit and giving you certain interest on your money. As seen by us in the example above, the bank led to growth in the town. More money was there for exchange and the money supply increased, leading to economic growth in the town. You might think that your money is not safe in the bank, but by fractional reserve banking at least a part of it is always safe and better than what happened in the Great Depression, where people lost their whole life savings. Banking is a business, so they will not just store your money for free. So they give you interest on deposited money and loan out your money to get interest. Some banks with 100% reserves take a fee to store the money, but the money is 100% safe. This is used by ultra-rich people who want it to be safe, as the amount insured by the government is very less compared to their money. In conclusion, fractional reserve banking can boost the economy if the banks act responsibly with people's money, and also if the government puts good regulations to ensure it and safeguard the public and prevent a crisis.